Welcome back to the third segment of the Tax Time. Your taxes matter. The show with Ajay Kumar, CPA of Sai CPA Services. Tax planning, what can you do today, right? That's what we've been discussing.
Absolutely.
The things that you mentioned, that's fine, that's very helpful. And besides that, what more can be done?
Well, thinking out loud, you can consider buying a home as opposed to renting. Rents are pretty high in these days. Whatever money you are using for the rent, you can use the same, in some cases even less money, for your mortgage payment. So if you were to buy a home as opposed to renting the home, when you're renting it, the rent that you're paying is not deductible. But when you buy the home, it opens up a lot of opportunities.
Sure.
The mortgage interest is 100% deductible even now, even under the new tax reform bill. Property tax is deductible up to 10,000. Home equity line of credit, as long as you used, there is a lot of confusion about it. As long as you use the home equity line of credit to improve the home or as a part of the original indebtedness, you can still claim up to $100,000 of home equity line of credit interest.
Yep.
You can buy a home up to $750,000. That's the mortgage limit that the government is allowing.
True.
All those expenses suddenly become claimable.
Absolutely.
And turning out to be less than the rent that you are paying anyway. So it creates an opportunity for you to manage your tax liability and parallelly create an asset for you.
Good.
Similar to the retirement planning that you have.
Yep. I mean, purchasing home, owning a home is always very attractive. It gives
It's a good
gives you a
idea.
lot of benefits.
Absolutely.
You know, and then if the amount is pretty same, the mortgage and the rental amount pretty much same, or even if mortgage is a little bit higher, it's still worth
It's a good idea.
to buy a home.
Absolutely.
All right, Ajay ji, after that rent versus buying a home option, let's just go to the section where I think some of our viewers have sent in some questions.
Sure.
And the viewers, any tax related question that you have, you can send us an email, taxtime@tvasiausa.com. No question is a silly question, seriously, and agar aapko lagta bhi hai silly question, so we won't mention your name on the screen. So, but please do ask any tax related question that you have, and Ajay ji will definitely answer that. One such question has come in, how about foreign income?
So foreign income, viewers, is supposed to be taxable for you. The key here is the foreign taxes. If the countries have treaties, let's say India and US have tax treaties. So the income that you have in India needs to be included on your US tax return, but the taxes that you paid over there are deductible against your US total now tax liability. It's not a refundable credit. So if your US tax liability turns out to be lower than what you paid in India, US government does not pay you back. But as long as you have paid some taxes in India on that income, you get credit for paying the taxes in another country. So it's taxable, but not necessarily you will have a tax liability.
Correct.
For this foreign income.
I mean, they have simplified it pretty well, and it's not that complicated. All right. Should someone work as an employee or a contractor?
It depends on your situation. An employee has certain benefits. The employer pays certain taxes, the Social Security tax, the Medicare tax. Social Security is 6.2%, Medicare is 1.45%. So half is paid by the employee, half is paid by the employer. So when you are working on W-2 as an employee, almost 7.65% of the Social Security and Medicare is paid by the employer on your behalf. While you are working for yourself as a contractor, as self-employment, you end up paying all these taxes. So you have to find out in your situation what makes most sense. So hypothetically, if your W-2 rate is $50 per hour, your contractor rate must be at least $55 to break even, to make it even. And then you have to see in your situation, does it make sense for you to start a business, to start an LLC or an S Corp? If it's a consulting business, you probably are best suited by creating an S Corp and running your own payroll. If it's a cost of goods sold type of business, manufacturing business, then you can have an LLC where the cost is upfront and the profit is not guaranteed. In a consulting business, you work for 10 hours, you get paid for 10 hours. So the profit is almost always guaranteed in a consulting business.
Sounds very good. Now, insurance agents, there are many individuals out there who are insurance agents. They work for a certain insurance company. How does their taxes and deductions work? I mean, are they allowed to take many deductions as being an insurance agent, such as traveling expense, office expense?
Absolutely. There's a great confusion about it. And this confusion became worse with the new tax reform bill. So what happened is, under the new tax reform bill, employees are not allowed the job related expenses. You cannot claim your travel expense, your phone expense, going here expense, going there expense if you are an employee. A lot of these insurance agents are employees. A lot of realtors, like insurance agents, they do a lot of traveling. They do a lot of going around, running around. They have to invest a lot of money out of pocket.
Absolutely.
So they have been put into a separate category. And this is called a statutory employee.
Okay.
If you are an insurance agent, you are a statutory employee. On your W-2, you will see the box 13 selected, and then you have the right to claim on Schedule C some of these expenses, including the travel expense, including the gift, including the marketing, including the advertising, all these expenses. Like a self-employed person, like a small business owner, you are allowed to claim all these expenses if you are an insurance agent or if you are a realtor.
Okay, interesting. With that note, just a couple of questions that we had. I just wanted to share it with you, so that way our viewers will be educated more. And any tax-related question that you have, remember, text time at tvasiausa.com. That's our email ID. I'd like to thank Mr. Ajay Kumar, CPA, Sai CPA Services. Thank you for taking time out in busy schedule and be here to advise us and to guide us and inform us. We'll be back next week, same place, same time. Remember, I am Sanjeev Pandya, wishing you all happy and tax-free weekend. Welcome back to the second segment of the Tax Time. Your taxes matter, viewers. Every week, Ajay Kumar, CPA, Sai CPA Services, joins us in this show for your benefit, because the information and the knowledge that he shares with us, it's really, really helpful. What we are discussing today is the tax planning, what you should do today. That's exactly the topic is. Now, with this tax planning, Ajay ji, by default, and I guess for important reason also, IRA comes into my mind, SAP, 401k, and then education planning comes to my mind. So let's just take one topic at a time, and let's just give out as much information possible. Start with IRA.
Absolutely. So IRAs are two types at a high level. You can have the regular IRA and the Roth IRA. The regular IRAs are tax deductible. They reduces your taxable income, so you save taxes now, as opposed to Roth IRA, which are after tax contributions to your retirement plan, and you don't have any tax saving now, but the growth is not taxable. So in a regular IRA, there is no income limit. Anybody, everybody can contribute as long as you have earned income. What it means is, as long as you are earning, you can contribute. For spousal, if your wife is not working, you can still contribute towards her IRA from your earning. So spousal contributions are allowed, but you can't contribute for your son's IRA if your son is not working. Only for the spousal IRA it's allowed. The limit for the IRA contribution is $6,000 per person. So 6,000 for you, 6,000 for your wife, $6,000 per person, and it increases to 7,000 if you are over 50 years old.
Interesting. Now, IRA stands for Individual Retirement Account.
Absolutely.
And I must say that it's been one of the most popular, one of the most helpful tax planning method.
Absolutely, because almost everybody can contribute towards IRA. If you have earnings, if you have cash, if you have enough money,
I think
everybody should do it.
Whoever can do it must do it. And Roth IRA is one of the branches of IRA which has been created to help out certain kind of individuals. The bottom line is whether you pay tax upfront or you pay tax in the end. That's only the difference.
So for the Roth IRA, there are certain income limitations. If you are married filing joint, so your income needs to be less than 193, otherwise it phases out. And if your income is more than $203,000, you're not allowed to contribute towards Roth IRA, but you can still contribute to a regular IRA. If you're contributing towards your regular IRA, your taxable income in the year you are contributing goes down. So you save some money upfront.
Okay, very good. Now let's go to 401k, and with 401k, let's just talk about SAP, SAP.
Absolutely. So SAP, or Simplified Employer Pension Plan, is most popular plan for self-employed people.
Ji.
If you have your own company, one-man army, you are the business, you are the owner. In those situations, SEP plan is the most popular plan, most widely used plan. The limits are in SEP, the maximum amount you can contribute is $56,000. Remember, we were talking about the $6,000 for the IRA. Now compare $6,000 to $56,000. The limits are huge. So you can contribute up to 25% of your W-2 wages. So if you have an S corp and you're running a payroll for yourself, so the limits are whichever is less, 25% of your payroll or 56,000. Say if you're running a payroll for yourself for $100,000 in your S corp, you can contribute 25,000. If you're running a payroll for yourself for 200,000, you can contribute up to 50. But maximum allowed is $56,000. That's the SEP plan.
Correct.
If you have an LLC or an Schedule C business, in that case, you're allowed up to 25% of the net profit. Whatever your net profit is, 25% of the net profit or $56,000, whichever is lower in your case. That's the SEP plan.
You said 25% or 20%?
25% on the self-employed,
Achha.
LLC, net income, or depending on the type of business.
Correct.
If you have an S corp, then you're running a payroll for yourself,
Right.
then it's 20% of the wages.
I see. Okay, thanks for clarifying that.
Absolutely.
401k. 401k, which I think it's a very, very attractive place to put your money, park your money, and then just see your money grow and grow and grow.
Absolutely.
Stock market has been volatile, and people are a bit reluctant to put money into 401k because you never know with this volatility in the stock market. One day it could be up and down a couple of 100 points here and there. What's your advice, and how 401k is still good plan for the tax planning?
There is a confusion, it's a misconception. So if I were to contribute into 401k plan, I'm bound to the market risk. 401k is a vehicle to put some money aside out of your regular pay for the retirement. You don't really have to invest your 401k money into stock. You can create a fixed deposit for your 401k.
Correct.
You can keep the money into your money market account. If you choose to, you can keep this money into a savings account.
Correct.
People tend to put this money into fixed deposit because they can't really withdraw this money until they retire. So they know they have no access to this money for n number of years. So why do I keep it in the savings account?
Correct.
And that's when they are looking at the long-term perspective, they end up sometimes investing this money into the stock market. But if you are concerned about the volatility of the stock market, you still contribute to the 401k, keep this money into a fixed deposit until you feel comfortable in the market.
That's a very conservative option, but it's out there.
It is out there. So the idea behind the 401k, from the tax perspective, the money that you're contributing to the 401k is not taxable for you right now. So the limit for the 401k is 19,000 for 2019. For the last year it was 18,500. They used the CPI to increase this limit. So for 2019 you are allowed to contribute up to $19,000. If you are over 50, then the limit increases to $25,000. But this money that you are contributing is not taxable for you right now. It doesn't matter where you put it. You can put it in a fixed deposit, in a savings account, or you can put it in the market. But you get the tax benefit for just putting it aside for your retirement.
Good, very good point. Now, qualified tuition plan.
So this qualified tuition plan has seen a lot of changes. This year, especially under the tax reform, you are allowed to take out up to $10,000 from your 529 plan and use it however you choose. For any type of religious education, for any type of secondary education, high school education. What used to happen before the tax reform, this $10,000, the 529 amount, could only be used for an accredited college after the high school.
Correct.
You couldn't use it for the secondary school, you couldn't use it for the high school, you couldn't use it for the religious school. Now under the tax reform, as long as it's an education expense paid directly to that institute, it can be used for any purpose. So the limits have been removed. Now this 529 plan has seen a lot of increased investment. A lot of new people are investing who did not want to invest into 529 plan.
Or and then you definitely think this is one of the
all these investments. I think
IRA,
retirement
401k,
plan,
SAP, and then
all these plans are a good way for you to manage your tax liability. To see what income tax bracket you fall in,
Yep.
how much money can you contribute, and the best part,
Ji.
you don't have to contribute in 2018 for 2018. You have till April 15th of 2019 to contribute for 2018. So you sit with the accountant, look at your situation. I'm in 30% tax bracket, but if I contribute 7,000, now my highest income tax bracket happens to be 28%. So you don't really have to contribute this money last year. You can make this decision while you are filing your taxes. And at that time, you can decide if you want to contribute to IRA plan or SAP plan. 401k needs to be contributed
By
in the
December
prior year,
31st,
by
yeah,
December
exactly, by
31st.
December
Because 401k is shown on the W2.
Absolutely. But this one is good because if you contribute now, then your savings or planning is up there, and then you're actually reducing your tax liability. So
Absolutely.
that way it works out better.
Yeah,
Anyway, tax planning is the topic for the day. We're going to take a break. We'll be right back with more information after this message. Hello viewers, I am Sanjeev Pandya welcoming you to another episode of the Tax Time. Your taxes matter. This weekly show here, we give you all the updates, all the information you need to know about taxes. That is, of course, with the help of Mr. Ajay Kumar, CPA of Sai CPA Services. Once again, he has joined us. So welcome to the show.
Thank you, Sanjeevji. Thank you.
All right, thank you. Taxes, and with taxes, of course, IRS.
Absolutely.
Comes into my mind. What is IRS's motto? Do you know?
I'm not sure. IRS motto is to make sure everybody pays their fair share of taxes.
Very nice. In reference to that, if I say it in better words, IRS motto is, we have got what it takes to what you have got.
That's very funny. Absolutely.
Well, in a funny way of saying it, that we've got what it takes to take what you've got. That's
Absolutely.
exactly what it is, and they are good at it. They are very good at it when it comes to taxes. Anyway, in last week's episode, when we talked about most overlooked tax deductions,
Absolutely.
This week we're all set to bring you another tax informative show. Viewers, as you know that for almost everything in the life, planning is important.
Absolutely.
But when it comes to taxes, extra planning, extra knowledge, and whatever information that you have, it really helps you to plan, because that way you can reduce your liability, and most importantly, you can invest your money wisely.
Absolutely.
So in this episode, let's talk about tax planning, what you can do today.
Sure. So a lot of times when the individual shows up for their taxes, we end up telling them, you cannot do this, you cannot deduct this. How about this? Where are the receipts? And there is no pre-planning. They are bringing this box of documents, these receipts, to the tax preparer at the end of the year. A lot of times, if people invest little bit of the time beforehand, they can save a lot of money on their taxes. That's why tax planning is important. In our last week's episode, we talked about most overlooked tax deduction. Today we want to talk about what can you do now, today, to make a difference in your tax liability tomorrow.
Absolutely. Number one thing comes to my mind is retirement savings account.
Absolutely.
That's
Absolutely.
It's a retirement and savings account, very self-explanatory.
So in a retirement saving account, a lot of times, depending on what type of account it is, if you contribute towards your own retirement, it reduces your taxable income. So you don't really pay the taxes on that income depending on the kind of plan you have. And if it's a regular plan or the growth plan, tax deferred versus tax now plan, so your taxable income goes down, so you end up paying less taxes. So the theory is, when you retire, that at that time, since you are retired, you're not making any money. So when you withdraw that money, you will be having a very less tax liability in comparison to when you are earning, you are in a much higher income tax bracket.
Then that's definitely very, very helpful. A lot of people also go with shoebox approach. What exactly is shoebox approach?
So in a shoebox approach, the theory is, a lot of times in January, February, they will start the nifty Excel spreadsheet to track everything, and as soon as the summer hits, they stop doing it because it's cumbersome. They can't follow it up. So the shoebox approach is typically advised for discipline. If you have a receipt, you don't have enough time, just put it in a shoebox. It could be any box. If you have something that you think can be useful tomorrow, take it up, put it in a box.
Exactly.
And at the end of the year, you're going to spend a couple of hours to go through this box, or go through all these receipts, and then decide what's deductible, what's not deductible.
That is actually a very, very good suggestion. Just put into any box. It's called shoe box, but you can put into any box.
Absolutely.
Okay, with the tax planning, Ajay, one thing I know that it's quite important is hobby versus business, because you have certain hobby and you spend money to support that hobby. How much is of that tax deductible? And if it's a business, if that hobby turns into business. So let's just shed some light on hobby versus business.
Absolutely. This hobby versus business discussion goes hand in hand with tax planning. A lot of times people have this side business, which is a hobby. So I'm an accountant and I like cooking, like woodwork, and I start doing it on the side. All the expenses related to that activity are not deductible for me because it's seen as a hobby. The difference is the way the IRS looks at it. Is there an intent to make money out of it? And how do you prove the intent? If I'm really cooking, am I doing some advertising? How many times did I try to sell it to make money? Was there a real intent to make profit, to make money out of this activity? But if you can show it by incorporating a separate business, an LLC, and we had a separate episode on what type of business you can choose, then all these expenses are deductible for you. You can save money on your taxes by taking certain actions beforehand. You can't go to the accountant, by the way, I have a side business. What's the business? Oh, I do some woodwork. Where is the intent? Oh, there is no intent, I couldn't sell anything. All those expenses do not count anymore.
Okay, that's interesting. I mean, there has got to be a line to be drawn.
Absolutely.
That's what you're trying to say.
By incorporating the business, by starting the LLC, S Corp, or whatever business you want to start, you are showing an intent. If I did not want a business, why would I start an LLC? Why would I start a business?
Okay.
So it's going in your supporting agreement. Supporting argument is, I'm trying to start a business here.
Absolutely. Okay, medical expenses, how does that fall into tax planning?
Well, the medical expenses used to be deductible up to 7.5% of over AGI. So if your AGI, adjusted gross income, taxable income is, let's say $100,000. So the medical expense over $7,500 were deductible. So for this year, there is still $7,500, but going forward under the new tax reform bill, they have changed this limit to 10%. So with 100,000 of AGI, adjusted gross income, medical expenses over 10,000 are going to be deductible. So now you need to plan it right. If you have two children and they both need some sort of denture, instead of doing it one this year, one next year, do it together, do it in 1 year. So if you have certain medical expenses that you can plan properly, then try to put all of them in 1 year as opposed to differing it in multiple years. So you can cross that threshold and claim those expenses.
Okay, and the 1 year is basically January to December.
It's the calendar year.
It's the calendar year. Okay, I just want to ask you a question to clarify certain things. In the medical expenses, only doctors' visits are the part of 7,500 or 10,000, right? Prescription, can it be part of it?
Anything is fair.
Anything. You don't need to have receipts or nothing like that.
Well, you do need to have some sort of proof.
Okay.
But a lot of times we don't need the receipt. If you are paying through the credit card, and I can
that's
show.
Your receipt.
That's your receipt.
But prescription drugs that you pick up from pharmacy, is it part of 7,500?
It's all out-of-pocket expense. It could be the doctor's visit. It could be your chiropractor. It could be some sort of educational thing that you took. It could anything out of pocket is all fair game.
Okay, all right. We actually have more coming your way when it comes to this tax planning, what you should do today. That's all coming up right after this message.